Ridham Desai of Morgan Stanley, of course, has been writing on and off about India and what his view is. But this time around, he's written a very interesting piece. And this talks about the style of investing. And why he's saying is that there is a shift in the performance of how the market is behaving. And this is gaining share as far as the new growth cycle is concerned, which means that you are entering a new growth cycle. This is led by strong policy action, which is something that he has already indicated. And this, supported with global markets, align a cyclical and structural factors, make a shift or a case for a shift of investment. Now, what he's saying is that value style is gaining in market share. Now, there are two kinds of investment style. One is value and one is growth. And what he's saying is that value stocks, those who trade far lower than the lowest factor in terms of valuation, have started to outperform or see outperformance in the market. Outperformance vis-a-vis high PE, high price to book value, where probably one is seeing that low PE, low valuation stocks are actually trying to do well, whereas high dividend yield is generating a positive alpha. Value trends tend to correlate with the outlook of the economic activity. So as the economic activity tends to pick up, that is something which essentially tends to gain in a lot of traction. That's what he is telling his clients. Now, when you talk about the growth style of investing, he's also pointing out that quality or several quality stocks since 2020 have not particularly done that well. That is because the value style of investment, growth style of investment is probably not doing that well. However, since 2017, growth of defensive companies, has outperformed quite significantly when you compare it to domestic cyclicals, and that, according to them, makes cyclical as one of the best plays or one of the best cases to be in. They believe that the small and the mid cap space or the rally will actually get broader from here on, and that's why small and the mid cap space should do well. It's not only this, but they also believe that some of the other economic linked domestic sectors should actually do well. People earlier were just chasing momentum. As momentum went up, momentum stocks saw buying, but this time around they believe that is something which will not continue. This is a similar behavior what market was exhibiting before 2002, 2003, or maybe even before 2008 and 9. In terms of their portfolio strategy, they continue to advise that this is a stock pickers market. A rally has happened in the market, but broader markets would tend to do well, which means that selectively stocks within sectors or sectors as a whole particularly will continue to do well. They believe that growth will surprise on the upside. This is for the economic growth, and the rates have probably bottomed out in the near term. They also say that real rates will be negative through 2021, and that makes them believe that domestic cyclicals would actually tend to do well. Exporters or domestic cyclicals over exports would do well. Rate sensitive small and mid caps over the larger space would actually tend to do well. But they are not saying that there is no risk to this particular call. The risk to this particular call is the global liquidity turning less supportive as and when inflation prompts in. The words of tightening tend to come in around the world. The resurgence of COVID cases, all these are existing risks that are there to the current style of value investing that they are suggesting to their clients.